So as I was saying, if we see another 0.5% increase, drop in rates, what it'll mean is that our payments on bond will reduce even further. So another 0.5% cut would mean that we start looking down in the area of about 18,000 rand to service that previous 22 plus thousand rand a month. Assuming a rental of 16,000 rand a month on that, as an example, on that type of unit, netting off all the costs and expenses, there's about a 2,500 rand a month shortfall. Okay, so obviously that's something that as a landlord or an investor you'd have to chip in. However, what's happening is that your property is growing in value. So yes, you are servicing an extra 2.5, the deficit. However, the growth on that type of property, if we use a nominal and quite a risk-adverse forecast of 7%, the property is growing in value every year by about 210,000 rand because it's on the entire amount. So going back to that thing we were talking about, gearing. So that's sort of an indication. When we merge those two numbers in terms of your rental income plus the value of your escalation, your returns as a cumulative are roughly between 13.5% and 14.5% per year over a 3-year period. So let's say an average of 14%. We've then done analysis on taking that 600,000 and actually just sticking it in a fixed deposit account, earning your 5%. So that's the big issue. The big issue here is that not only is lending decreased, but if you've got money sitting in the bank, in a fixed call account or something like that, it's actually decreased, obviously, because the interest rates have dropped. So your rough numbers there are about 5% roughly, depending on what facility you've got or whatever. But let's assume a 3-year fixed deposit, roughly in the region of 5%. Then you get taxed on that because it's income on the interest. So your net margin on that, it's sort of hovering in the area of about 3%. So we've got a 3%, obviously escalating up, with compounding effects over 3 years. You're averaging like 3.2 to 3.5%, and that's real numbers. It's not something that that's actually numbers that you're going to see on your return on investment. There's no capital appreciation other than the interest portion. So you've got a 3.5%, and you've got an average of 14% on property. Okay, so when we correlate those two numbers, and this is quite an interesting analysis, is when we correlate those two numbers, what you see an increased value of about 994,000 rand on your fixed deposit account over 3 years. So let's round it up, say 100,000 rand, and on the property valuation over 3 years, about 820,000 rand. So I don't know if we can just quickly zoom in on that little graph. So that's giving you an idea of exactly what's doing. So your cash sitting in current account versus sitting in a property in a good location that's growing. That's the differential. So the differential between the green and the blue line. So to give you an idea, on 600,000, 100,000 rand return over 3 years. On 600,000, 800,000 rand return over 3 years by investing in good property with good locations and good demand. So where is that? That area has to be in Durban area, has to be coastal, has to be convenient, has to be secure, and has to be managed. So those are the keys that we've been talking about buying. Good location, macro and micro, close to the working hubs, Umhlanga, the Gateway Precinct, Canubia, close to the Aerotropolis zone, which is growing. Obviously, seaside of M4, and generally what we've seen, the trend is moving north. So, when we talk all those things together and you actually sort of compound it, it's really talking to Sabaya. It's talking to off-plan developments. Those are where you're paying minimal fees and you're getting maximum reward for your buy. And I think to capitalize on this interest rate, property off plan going forward, developments, yes, you're going to see maybe 2 years of the ability to capitalize on this really low interest rate. But for guys that have got the ability to gear some cash that is sitting in the bank, use it now, because obviously be cognizant that we are going to have some hard times. But if you've got some spare liquidity and you're paying rentals as an example, turn that into property that you can actually buy. Gear it with the banks. The banks are going to be aggressively lending. They need to lend. They need to stimulate the economy. We need to see money going back into the economy, and they're going to be looking at properties. They're not going to be looking at investing in businesses or commodities or oil or anything with exchange rates, because exchange rates have gone through the roof. stock markets. No one knows where that's going. So, they're going to be looking at lending into areas that gives them security, that gives them proper brick and mortar asset value, which is, over time, it's stood the test of time over and over again. So really, as an investor or as someone that's renting with a bit of money saved up, this is the time to get in. Get in now. We have got a window. I'm not saying it's going to be that 3-year window. We could see a surge back, but by then your rental's ticked up, at 7 or 8% a year. So you've decreased that buffer even further, and typically 3 or 4 years in, the margins narrowed on your rental and versus your income. Your rental income versus your bond repayments. So in 3 years' time, a 16,000 Rand a month rental is probably going to be in the region of about 20, which once again, if the interest rates do start ticking, you've got movement because, that 4,000 Rand increase in your rental over 3 or 4 years has now, chipped into this differential. So it allows another 1% interest rate increase, which will come. We will see it going back up, over sort of 2.5, 3 years plus. So, that's my advice as a developer and a property investor. All my personal assets that I invest in have always been brick and mortar, only because it's the game that I'm in, and I don't understand the other stuff, and I can't control it. The demand for resi accommodation, and I'm not talking your 20 million Rand apartments. I'm talking, sub 3.5 million. That's the market. That's the demand market for rental. So I'm going to just go into questions. We're going to try and keep it quite tight. Apologies for the interlude between the two videos. So we're going to jump straight on. What's your thought on when interest rates may start to increase again? So, Evan, we had a lot of discussions with the banks. We've talked to them about, looking at fixed rates. Fixed rates give us a really good indication of how they're pricing in increases. So over the last, couple of days, we've got about 3 fixed rates, a 2-year fixed rate and a 3-year fixed rate, sort of all hovering in the 7 to 8.2% bracket for the 2 or 3 year option, 7.2 for 2, and about 8% for 3. So we can see that the banks are pricing in a reduction and then a slight click up, which we see in that 7.2% for 2 years, and in the third year probably another 0.5%. So that's what typically price about 8%. So we do see, considering we're at about 7.5% now, that sits bang in the middle of those two numbers. So we see an average over the next 3 years of probably in the region of 7.5%, which is, seriously unprecedented, considering that a lot of guys borrowing will probably get prime less a half. So, really effective rate for us of about 7%. So many retirees are feeling uneasy about the money they have in the bank. What would you advise them on when it comes to putting their money into property? That's a great question. It's this fine balancing act, as we've seen our president been talking about, when we can release and not undoing all the good work we've done. So, similarly, everyone wants to, get the upside of this great rate and low risk in terms of yields, etc. However, my advice, and I'm not a financial advisor, so do consult your financial advisor if you've got one. But my advice is obviously, keep a little bit of money that you've got a little buffer or a war chest in case something happens. I think it's always advisable to have some contingent, probably 2 or 3 months. And then I would be looking seriously into smaller property for the retirees or guys with limited cash, and I'd be looking at stuff that's got really high tenant interest, because you want to obviously attract tenants immediately and get that income stream going. And the whole idea with property is that, yes, you're still earning your salary, and you still, your lifestyle still costs you exactly what it will and what it does. You've just got a secondary income which is saving money. So going back to that 3 million example, to saving 210,000 Rand discreetly, which is passive income on the capital growth per year, and that's a phenomenal amount of money to be saving. That's working for you as well. So it's almost like employing a secondary doctor that's working for you. You're earning off them. So it's something that you are earning without putting a lot of energy into. So for me, retirees, I think guys are very nervous about putting money into funds. We've seen a lot of the big funds, a lot of the reputable funds have significant losses, 10, 20% losses over the last 2 months. And a lot of guys can't afford that. So great question. Should we be hoping for 100% bonds from the bank? No, I don't think we will see that. I think we'll continue to be looking at about 90%, 80 to 90%. I think that's sort of that's what it was before, and I think that will continue. I think banks will maybe a little bit more aggressive with their lending rates. So you might see a couple of prime less 3/4. I know that the reserve banks have dropped the lending ratios for banks, so we should see a little bit of that profit margin from the banks coming through to clients, but not significant numbers. But yeah, I think the lending criteria will still be that probably a maximum of 90% lend. Do you think banks will ever get back to 100% bond offers? I think it depends on the value of the property. If it's a significantly low value property and they see it as a very low risk asset, you might get that. I'm talking now sub 1 million rand properties, but typically I think the bank's going to be cautious. It's an uncertain time, so they want to see that the client that's borrowing is obviously able to afford it and has got a bit of equity or skin in the game. So that allows the banks, if something does go wrong, they know that they've only got to find 90% of that property value. So they like to have that little cushion of safety. Could we opt for a fixed rate at this stage? What will be allowed? Would that be allowed, keeping in mind that it's an extraordinary circumstances? If I opt for fixed on a property now, I will always benefit in my purchase. So yes, fixed rates definitely are available, 2 and 3 year fixed rates. As I've said, you'll see they are priced a little bit higher because they take into account market movements over the next 2-3 years from their financial analysts. So yes, I think that will happen, and it can happen. But at the moment, looking where we are, I would probably suggest a 2-year fixed option. However, bearing in mind, once you fix the rate on a property, you can't get out of that without penalties. So it does sort of hamstring you a little bit, because if you get a guy that comes along once you've bought a property, says, listen, I really want this property, and he offers you 3.6 million in 18 months and you've paid 3, it doesn't allow you to have that flexibility to sell. So you've just got to be cognizant of that. I think the fixed rate is a really good indicator that the interest rates aren't going to be moving a hell of a lot in the next 3 years. Hi Charles, how long do you think the interest rate will stay this low? So I think we'll probably see it dropping within the next 3 months. I've made a couple of forecasts which we've sort of nailed, so I don't want to make a whole lot more. Strike rate's quite good, but I think we will see a little decrease, probably coming between September, October, November, somewhere around there, just before end of the year. That's sort of the usual time they cut. I think we're going to see probably half a bit drop, half a base point drop by then, and then I don't see much happening. Maybe another click up in the new year, March, April, something like that, to get back to where we are now. So that's where I think we'll be. So realistically, over the next 12-month period, I think we'll the rate we've got now is what we'll see for at least the next year. Okay, so what we're going to do is we're going to just cut it there. We're going to put some graphs and some spreadsheets, some a bit more information for the investors to actually have a look at some of the stuff that we've been doing. We're going to put it on our Facebook website. We're going to, please guys, just go and have a look at it, run through the numbers. Numbers generally don't lie. Sometimes they don't tell us what we want, but in this case, they are telling us a significant story about getting into the property market. So keep safe, everyone. Well done for observing all the regulations. God bless South Africa. We look forward to chatting on Tuesday.